Hello traders, what's going on? Today is 21st of September, currently 2:16 p.m. Okay, so today is a very important day. We have FOMC coming up slightly after midnight at 2 a.m. So since we have a FOMC day, right, there's a lot of volatility to be expected, a lot of up and down. So because of that, this video is going to cover something that we have not covered before, and that is how to use option to hedge your portfolio, which is actually the proper use of option. A lot of institutional portfolio managers, they use options to hedge their position during this kind of volatility season now, okay? Whereas retail trader like us are trying to use option to YOLO here and there, but right now we will try to use option to achieve the purpose that it is intended for. Of course, using option to hedge your position is not new. It is not like a secret. It is a well-known it's a well-known strategy lah, but when you look around in the online, you probably will just find a lot of theories, but you don't really see an actual execution of the option. How do you apply it in a real life situation? Okay, so in this video, right, I'm gonna show you how I can plan my option hedging against the incoming volatility, and then I can maneuver my portfolio to protect my downside lah. Okay, so these are the kind of thing that I tend to spend a lot of time on. So I'm sure most of you have read through my daily routine, and and if you are wondering why I am spending a lot of time, right, these are one of the few areas I will spend a lot of times on. Okay, so first, before we even structure a proper option hedging, right? Let's take a look at my open position for now. Okay, so my open position, you see right here, I currently have 3 short position. So as per my previous update, right, I have gotten rid of both of my Facebook short position. I've gotten rid of the Google long position, and I have also got rid of General Mill long and target short. So for the General Mill and target shorts, right, overall that spread trade turns out to be break even, slightly profit because yesterday target went down quite significantly lah. I believe it was like 2.8%. At one point it was -3% like that. Okay, so that spread trade was a break even, so doesn't matter. I just let it go, mainly because I want to avoid the risk from General Mill earnings that is coming out before market open today. So if you did not get rid of your General Mill long, right, you are actually now exposed to the earning, because there's no way you can trade before the earning comes out. Okay, maybe during pre-market you can run first, but the spread during pre-market can be a bit wide lah, so I'm not sure how is it going to be. Okay, so what I have left is I have LPX short, Marriott short, and General Motor. Okay, so for simplicity's sake, right, I'm not gonna include all the YOLO option position because those are within the YOLO portfolio lah. Okay, if I include those, it will be way too complicated already. So I'm just gonna use my the proper portfolio to sort of structure my option hedging. Okay, so currently, because all of my 3 positions are short, right, I actually have exposure to market risk. All 3 positions are exposed to market risk, meaning if market suddenly dive up, right, all of my 3 position is gonna get hit if there is a sudden if everything chung up lah. Okay, all of these 3 positions are going to get hit. So I have 3 market risk, and I also have 3 sector risk, because all of the I have 3 different sector, and each sector is short position. And of course, total risk is 3 also, because I have 3 trades here. So total of 3 short position and 0 long position. So rewind back a couple of weeks, right? I have as high as, I believe, 5 net short position about 2-3 weeks ago. But now that the FOMC is coming, right, I have drastically reduced my exposure, my market exposure to 3. Okay, so this is how I get rid of certain risks when there is incoming volatility lah. So now if you look at my open position based on the time that I send out the trade setup, right? LPX is quite in the profit with $1,300 profit. The rest are small negative. GM is negative $250 and Marriott in negative $300. So overall, I'm still up by about $772, which is fine. Which is okay. But let's talk about the market risk that we can face, the worst case scenario. So the worst case scenario here is that if after FOMC, the market rally very aggressively, the whole market goes up, chung up, okay? Like something Jerome Powell say, I don't know. So market just go all the way up. So when market go all the way up, right, my worst case scenario is all of my 3 short position is going to get hit with a stop loss. Okay, they are going to get hit with a stop loss. So I need to calculate what is my worst case scenario, which is all 3 position hit with a stop loss. But how much am I going to lose in this worst case? I know how much I am going to lose because I already know where's my stop loss. I have already pre-calculated it, and that is why stop loss is important. Okay, guys? Don't hold beyond your stop loss. If you have no idea where your stop loss is, then you have no idea what is your worst case scenario risk. Okay, it means that you are not trading ready. I don't know what you are doing. You are gambling. You better go to the roulette table. Okay, the moment you don't obey the stop loss, you are no longer trading. You are just pure gambler already. Okay, so because I know where are all my stop loss, and I know how much I am going to lose, right? I know my worst case scenario risk. And my worst case is actually about $2,000 per trade. Okay, so I risk about $2,000 per trade, mainly because my overall trading portfolio is about 150K, the capital. So $2,000 comes up to about 1.7% to 2% risk per position. So each trade that I take, I'm risking about a maximum 2%. Okay, in this case, $2,000 risk per position is less than 2%. Okay, so I'm gonna use $2,000 risk to calculate for simplicity's sake. So worst case scenario, all of my 3 positions get cut out, and I'm gonna lose $6,000. Okay, so let me just type out for you worst case scenario. Worst case scenario will be negative $6,000. So is negative $6,000 a big amount? Of course, that is dependent on your portfolio. A negative $6,000 on my portfolio is about minus 5% like that, or minus 4.5%. So it's not a big amount. So let's say if you have 3 short position and your worst case scenario risk is like you're gonna lose 20-30% of your entire portfolio, then you have loss sizing problem. You have loss sizing problem already. Okay, make sure you are not risking more than 2% of your portfolio per position. Okay, so right now I have a worst case scenario of negative $6,000. Of course, the best case scenario is that market continue to go down. If market continue to go down, then none of them gonna hit with a stop loss, and then I'm gonna make a lot of money on the short. So we don't talk about the best case scenario. Okay, we talk about worst case scenario. So I have a potential to lose $6,000 on a worst case scenario, and this number is fixed. I have planned this number. I have worked out this number. So this number is not going to change. It is fixed. It will only change when you start to shift your stop loss, when you add more position, or you didn't even plan your stop loss at all. Only then this number will be shift. But when I'm trading, right, at all time, I know what is my worst case scenario, and that is why I can always remain calm, remain confident, and don't do funny emotional shits like suddenly like exit and then go and re-enter again, and then do a lot of funny things Okay, I'm sure you all know what I'm talking about. Okay, so but let's say I feel that okay, maybe I don't want to lose this $6,000. I want to do a hedge. against this $6,000 in order to limit the downside, okay? Limit the downside on this worst case scenario. So what I can do is I can actually buy call option in order to limit this downside. Okay, so you can buy any call option that you want on the market, but of course, since we are talking about overall market, right, I will prefer to buy call option on counters that have that are considered major, that have major weightage in the index, but also counters that has already like dropped until don't know where already, like have dropped quite significantly already. So if let's say Jerome Powell says something very bullish, or he say like, okay, they are not gonna hike aggressively, then those counters that have dropped quite significantly, they will rebound the most, okay, they will suddenly spike up like 6, 7, 8, 9, 10%, those kind of level, okay. So two criteria. First criteria is it must be a heavy weightage in a index, mainly because everyone is gonna buy the index, okay. when Jerome Powell says something bullish, everyone is gonna buy the index. But we don't want to trade the index itself, mainly because index movement is very small. On a best day, right, S&P can go up about 3%, 5%, which is like not worth it. But counters like Nvidia can move up about 7, 8%. Counters like Tesla can suddenly spike up like 6, 7%. Okay. So we are not gonna use index to hedge, but we are gonna use specific counter, and the counter must have dropped to a very, very low point, and they must also be a heavy weightage in the index. And of course, the counter that I'm actually looking at is Nvidia. Okay, the counter that I'm looking at is actually Nvidia. So I'm gonna buy call option. Call option means betting on the upside in order to hedge against my short position. So you have to understand the purpose of the call option on Nvidia. It is not to make profit. Okay, of course your call option is gonna make profit if market spike up, but the purpose of this call option is to sort of cancel out the loss that I am going to take on my short position if market decide to rally . Okay, so there's another reason why I chose Nvidia also, not only because it is a heavy weightage in S&P and Nasdaq, right, but it has also dropped quite low enough already. So these are the two major reasons. And finally, the final reason is very simple. Jim Cramer is short. Jim Cramer is shorting. Jim Cramer want to short Nvidia, so we go reverse Cramer okay. So that's the although the last reason is a joke reason, but we have two very good strong reasons initially ready to choose Nvidia . And Nvidia is actually quite volatile. It's volatile enough that on days where it rallies, right, it can actually goes up quite significantly . For example, if you look at this period, right, if you look at this period like that, I do believe sorry, not July. Is it July? Yeah, July 15 was the FOMC period. I think it can go up about like 10% within 3-4 days . Okay, so that's basically why we want Nvidia. So we are also refraining from counter like Apple, mainly because Apple movement is not very volatile. Even on the most volatile day like this, right, it only goes up like 3%, goes up like 5%. But the second reason is that Apple outperformed the market in the past 2 days okay. So it probably have gone up quite enough already. So maybe it might not be going up as strongly if market decide to recover . Of course, if you don't like Nvidia, you can go for AMD also, up to you. But I'm going to use Nvidia as an example in this calculation. But you can use similar calculation to go and work out for yourself. Okay, so we are going to use Nvidia as a hedge against our short position. So looking at the Nvidia option chain, right, we are going for the option that is expiring this Friday. It's only 3 days. Okay, so the reason why we are going for option that expiring this Friday is because we just want to cover our backside for this week. for the volatility that is happening within this FOMC period. We don't want to hold this option beyond this current week already, because by the end of this week, right, we probably will know where the direction is. We probably know what Jerome Powell say. We can digest what anything that is in between the line of what Jerome Powell is saying, and we probably have a good direction by the end of this week. Okay, so we don't need to hold the option beyond this week. Okay, and because of that, right, you can actually get the option at a very, very cheap price. Because if you try to get NVIDIA option like maybe 1 month out, it's going to be quite expensive. It's not going to be, for example, I have highlighted the strike price at 134. So for the option that's expiring this Friday, right, the strike price 134, the option price is about $2.57. So okay, I'm gonna take the middle point, which is 2.6. Okay, 2.6. So the option price is about 2.6. But if you buy the same strike price but 1 month expiry out, it's gonna cost you like $4-5 like that, about double the price, which is not what we want. We just want to hedge for this week. Okay, so when you are trading, right, you need to understand your objective. What are you trying to accomplish? And you need to make sure that the tools that you are using can easily meet what you are trying to accomplish. So when people trade without rhyme or reason, because finger itchy, because follow Facebook, YOLO here, YOLO there, never think, then you probably will be lost. You have no idea what you are up to. Okay, so I'm gonna use 134 as a strike price, and then I'm gonna use $2.6, okay, $2.60 as my option price in order to work out the calculation. So first let's work out the break-even price. Break-even price is always your option strike price, which is 134. Sorry, 134 plus your option price, which is 2.6. Okay, so depending on how the market opened today, right, the option price might change. It might get cheaper because of time decay. But if NVIDIA decide to spike up or spike down, then the price will change also. So 2.6. Meaning the break-even price is 136.6. Okay. This is to say that NVIDIA need to hit 136.6 for your option to make money by expiry. Okay, the word here is by expiry. If by expiry, if an NVIDIA price is above 136.6, right, your option is gonna make money. If it is below 136.6, right, then your option is gonna expire worthless. So let's take a look at the chart and go and plan a bit. So currently NVIDIA is at 131. So what short-term memory 136.6. Okay, so let's work it out. Text coordinate 136.6. Okay, so this is your break-even price, which is quite okay. I would say it's okay. It's below this candle. But if let's say market were to spike up, maybe it can close the gap all the way at 145. Okay, it can close all the way at 145. Okay, so this is your break-even price. So I'm gonna project a possible price for NVIDIA if let's say market were to rally. Okay, so if everything bullish, market were to rally, right, maybe NVIDIA can hit somewhere about either around this level. I'm gonna use 145.5. Okay, 145. I'm gonna use this as a theoretical level that price can hit if the market spike up. So in order to hit the break-even price, NVIDIA have to go up 3.6% before this Friday. And in order to hit the theoretical target price, NVIDIA have to go up 10% by this Friday. Is it possible? Definitely. When we have FOMC triggers on a counter that has already dived down by a lot and is underperforming for the past few days, right, definitely can hit. But once again, right, we are not using this to make profit. We just want to protect our downside. Okay, but as long as the NVIDIA is above 136, right? NVIDIA is above this break-even price, you are going to make money lah, but it's just a matter of how much you're going to make money. So if it can go all the way to 145, then of course you will make a lot of money on this option. But if it is slightly above the break-even price, then you're going to make slightly lesser money lah. Depend on how aggressive is the rally lah. Okay, but here's the thing: if NVIDIA went up and closed slightly above the break-even price, right? Then most likely, the market is not doing a very aggressive rally, meaning maybe your short position may not get stop out, they may not hit stop loss, they may just go up a bit, and then they are not going to hit stop loss, and then you can still hold on to your short position, but you are still getting some profit from this option, okay? So that is the so-called the goal. But let's say if market rally aggressively, very spike up all the way where every single one of your short position is now hit with a stop loss, worst case scenario, then it is highly likely that NVIDIA can go all the way up to 145 lah. So that is what I mean by market risk, where everything is moving up or everything is moving down. Okay, and let's say if NVIDIA doesn't hit the break-even price, but in fact NVIDIA go down, okay? And if NVIDIA go down, right, what's gonna happen is your option is gonna expire worthless. Like whatever option you buy is gonna become zero, okay? But all your short position that you are holding, most likely they're gonna turn into bigger profit, even bigger profit than the option that you bought for NVIDIA lah. So in a way, it is sort of like a win also. So of course, these are just theory. You want to go and calculate a specific amount that you can sort of target. You need to calculate the amount of option to the appropriate amount of option to buy. You don't want to buy too many options and then end up losing instead of hedging. And then you also don't want to buy so little that it doesn't even work as a hedge lah. Okay. So in this case, right, once again, I'm going to use 145 as a target, mainly because if all my short position is going to hit with stop loss, right, then it is highly likely that the market rally very aggressively, meaning NVIDIA should be able to hit 145. But even if it does not hit 145, right, it will be able to hit like 142, 143 around the high level. Okay, so that is my assumption. But we will use 145 as a calculation, as for our calculation. Okay, so target 145. So what is our theoretical profit on this option if NVIDIA hit 145 by expiry? So potential profit will be 145 minus 136.6, and then this whole thing multiplied by 100, because one contract is 100 shares. One option contract is 100 shares. Meaning I'm gonna get, well, let me do quick calculation. I'm gonna get 145 minus 136.6 multiplied by 100. Okay, I'm gonna get $840. $840 profit per contract. Okay, per contract. But of course, because we are buying the contract for 2.6, right? Each contract actually costs $240. So in this case, right, if we hit the target by this, we are able to hit this target at the end of the week, right? Then most likely the amount that we are getting on this profit is on this option is 840 over 240. It is 840 divided by, sorry, not 24, is 26. Each contract is 26 because it is 2.6, which is the contract price, multiplied by 100. So our return is about 320% return, okay, which is similar to the Apple profit, which is quite similar to the Apple profit that we have gotten now. Okay, so this is our theoretical profit if we can get 145 lah, which is our worst case scenario lah. Okay, worst case scenario for all our short position. So if we are gonna get $840 per contract, then how many contract do we need to buy in order to protect our downside? So remember, our worst case scenario, we're gonna hit with $6,000 loss. So what? To calculate how many contract we need to buy, right? It's very simple. I'm just gonna do $6,000 divide by 840. Then what I'm going to get is 7.14 contract, but I'm gonna round it to 7 now. Okay, I'm gonna round it to 7 contract. So in this case, each contract is $260. So 7 contract will cost me 7 times 260. It will cost me 1.1820, $1,820. Okay, so if you look at this, right? If you look at this, you are going to spend 1.8K on NVIDIA call option contract as a hedge. Let's say if the worst case scenario happen, stock market spike up, all your short position get hit with a stop loss, you lost $6,000. But in the process, NVIDIA went up to 145. And because NVIDIA went up to 145, right, you will get $6,000 profit on your option. So this $6,000 doesn't include your contract price, because we have already calculated the break-even price by adding the contract price here already. Okay, this $6,000 is pure profit, doesn't include the contract cost. Okay, so we account for the contract price already. So we are gonna get $6,000 back from the NVIDIA option contract. So what does this mean? This means that we actually spend 1.8K to prevent a $6,000 loss. We spend 1/3 of the amount to protect our big loss. Okay, so is this a good trade? I will leave it up to you. Is this a good hedging? I will leave it up to you. Let's say if you have the potential to lose $6,000, do you feel that spending 1.8K to prevent that loss is worth it? I will totally leave it up to you. If let's say your account is very big, you are not looking at 6K loss, you are actually looking at $600,000 loss, mainly because you are a billionaire hedge fund manager lah. Then of course, yes, then if you are looking at $600,000 loss, you will probably want to spend like maybe 100K to protect your downside lah. That is definitely worth it lah. But let's say if your account is very small, you are looking at a worst case scenario of $1,000, then you can't even hedge. You can't even hedge because the NVIDIA share price, the NVIDIA option price is already $260, minimum $260 per contract. So I mean, you can still hedge lah, but you need to work out. Okay. So in worst case scenario, once again, I will repeat. In the worst case scenario, what's gonna happen is all your short position will get clear out, cut loss, but you're gonna make equal amount of return from the NVIDIA option, meaning you break even. You didn't actually lose money. But what this allows you to do is that now your portfolio is now empty. And because now you already have the information that, okay, market is bullish, you can shift your portfolio bias to the bullish side without taking any loss at all. You are allowed to reposition yourself without any losses. And this is the power of option. It gives you optionality, pun intended. But okay, let's go on to the other scenario. Okay, let's go on to the other scenario. What if market spiked down, market spiked all the way down, and then the market crashed, and then your Nvidia also crashed, and by the end of this week, right? By the end of this week, your Nvidia crashed until I don't know where, like 120 like that. Maybe just saying 120 like that. And then your option become worthless. Your option becomes zero. So what happened? You're gonna lose this $1,800. This $1,800 $20 will become zero. But if that's the case, it is highly likely that your short positions are going to give you a lot of money. So in this case, right, if all my position hit TP, if all my position hit TP, my risk reward ratio is about 1.4 like that, meaning if all my position were to hit TP, I will probably get about $8,400 in profit from this 3 short position. Okay, but if I minus away 1820 that I spend on my option contract, right? What I'm gonna get is I'm gonna get a total of 6580 potential profit if market spike down. So here is the downside, okay? If let's say market spike down and you did not buy any option to protect yourself, then you will actually make $8,400. But because you bought the option to protect yourself, right? Instead of making $8,400, you only make 6,580 lah. But the key thing here is that by spending the hedging on the option, right? What you have basically done is that whether market go up or down, you don't need to worry already. You actually remove your risk. You remove your risk entirely, and you are not holding risk anymore. So when come to option hedging, right, you have to ask yourself, are you willing to spend this amount? Are you willing to spend this amount to hedge your position? If you are willing to do that, then you actually have you can sleep better at night, okay? You can actually sleep better at night, and then you are protected on both ends. But if you are if you are very convicted, you have a very strong feeling, or you have some insider info that okay, market is definitely gonna go down, guarantee chop. Jerome Powell called me last night, say he gonna raise 100 BPS, market guarantee chop go down. Then if you have that high level of conviction, right, then you of course you don't need to hedge lah. Okay, of course you don't need to hedge. But this is just an example. So whenever there is big volatile event coming up like CPI or like FOMC, and you realize that your overall portfolio is overexposed, then you can actually use option to do this kind of hedging. But of course, the process of hedging is also, it takes times and experience to get used to it. In order to go and find out what is the good counter to do hedging, in order to pick a good counter, you need to understand which counter are the volatile one, which counter is probably oversold, it has the most potential to spike up. So for example, right, I'm not gonna use counter like General Mill to hedge my option, because General Mill on its best day go up like 1% only. What's the point of using General Mill to hedge using a call option? Those kind of stuff. Okay, so here, right, you probably learn a few things that which normally you might not think of, not just the hedging alone. You need to know how to identify high volatile period, high volatile days, and you need to know how to reduce your market exposure. You need to know how much you are exposed, and you need to know how to reduce certain exposure. And when you are doing this, right, you cannot look at individual stocks alone. You need to look at your holding on a portfolio level. On a portfolio level, right, you have to go and see which are the one that has the highest risk. So in this case, I have removed General Mill because it has earning risk also, which is why I decide to remove it instead. So all this stuff, right, they consume a lot of time. Portfolio management consume a lot of time. If you are a newbie trader, you have no idea what's going on, you just come into trading, then the only thing that you're gonna care about is buy, sell, go up or down. Your thinking will be very binary, bull or bear, up or down, short or long. So your thinking will only be at that level. TP level what? Where the exit price, where the entry price. So you are always looking for that magic number, the magic level, the magic stock. Your head only think of that. But as you grow as a trader, right, you will realize that trading is not binary. It's not bear versus bull. You can be 40% bear, 60% bull, and you can actually structure your portfolio to reflect slight bearishness, neutral, slight bullishness. It is not 100% one side or the other. Okay, so as you get more and more aware of all these additional stuff, right, you realize that actually you need to spend a lot of time to actually review your portfolio overall exposure and how to protect and think about all the possible scenario that can happen. Like for example, you need to think about, okay, FOMC coming up, what is the best case scenario for my portfolio? Do I need to hedge? Do I need to do something? Do I need to reduce my exposure? Is the worst case scenario gonna make me become handicapped? And then what is the best case scenario? You need to think about all these branching possible situation and make sure that for every single event that can happen, right, you must have a plan. So for example, let's say now I only have 3 open position. What if after FOMC market become bullish? Then what am I going to do? Am I just gonna sit there like a donkey like that? No, I already have a bunch of long position that I can take. I have a watch list full of possible long position ready. I've already planned those out. In case market become bullish, I have all these positions ready to go. And what if market spike down? The market is still very bad, 100 basis point high, market crash. If that's the case, right, I'm gonna add more shops. And of course, I also already prepared a lot of short position that I have. And in the middle, I can also prepare a bunch of spread trade in order to make sure that I am market neutral. So I have done all this preparation work. All this thing, right, they take time. I'm not gonna just sit there, wait for the price to hit TP level, hit stop loss level, and then hit ready, go out again and ask stupid question like up or down, buy or sell, can go up or not, can go down or not, all these kind of nonsense question. Because at the end of the day, right, your portfolio matters. Your entire portfolio matters. Whatever new trade you add to your portfolio, it will change your portfolio composition. And because of that, right, because of that, whether or not you are going to enter a new trade, whether or not you can or cannot enter a new trade, it is dependent on what is your current portfolio holdings. If you come and ask me if you can enter something or not, I cannot answer you because I don't know what you are currently holding. If you are holding 10 short position, I cannot recommend the 11 short. If you are holding 10 long position, I cannot tell you to make another long. So questions like up or down, long or short, can go up or can go down, all these questions are binary in nature. And binary mindset is the worst mindset you can adopt in trading. Okay, guys, so hopefully this session gives you a little bit more of, how should I call it, level up knowledge, okay? Level up your trading game. Try to bring yourself out from the newbie retailer, the shortcut mindset, okay? And make sure you are looking things more holistically. And have a good day, guys. We will have a meeting tonight. And of course, once again, we are ever ready for FOMC as usual. So we see how the Jerome Powell goes tonight. Bye-bye.